Hey, it's Anthony Meisner with Land Title. I wanted to bring you a Greater Metro Denver update for this month. And well, things are a little slow and there's not a lot of listings coming on the market. But all that being said, this is all going to change eventually, right? I mean, we're at the peak of the market here. This is a good sign for the market to be, slowing down and doing exactly what the Fed and, all that monetary policy is trying to accomplish. The only difference is people don't seem to be listing houses because if they didn't have to list a home, they're really not going to. You are still seeing buyers active in the marketplace, but things are just slow. So definitely if interest rates start to drop, expect that to change. The only thing that I think we were probably hoping for this year that we didn't see is we really wanted to see inventory rise and pull us out of this just really low inventory situation that we're in. And you can see the inventory right here. We're close to in line with where we were a year ago in inventory. And that was like, kind of into the rising inventory environment we got, but we're not going to see anywhere where we were towards the peak of the season. So when you saw those, inventory sitting on the market last year, all over town, really, right? You just aren't going to see that again this year. We're actually being below inventory levels going forward. So in a market like this where we have low supply and a lower amount of buyers, what it does is it creates an environment where, people only really sell when they have to. And with high interest rates, right, and people hanging on to 3-4% rates, there's a resiliency to list homes. And you can see it here in the month supply of inventory. We're in an ultra strong seller's market, right? 1.3 months of inventory. But the problem is everyone's still thinking about what's on the other side of that for them. So I think there's a lot of opportunity for sellers who are ready to sell product and get out of here, or if they have rental properties that they would like to sell, there's a lot of opportunity for those listings out there in the marketplace. But it really seems like most of the tide is riding across Greater Denver Metro. Pretty similarly, you got places like Arapahoe County that only have 1 month of inventory. Broomfield has 1.2 months of inventory. Obviously, you have stuff on the other end of that where you got Elbert County in 3 months, but for the majority of it, it's just a low inventory environment. It's going to stay a low inventory environment. It will probably rise throughout at least the fall, but not like what we saw a year ago. So that being said, what's that mean for your buyers? It means that days in MLS have been trending down. This should be about the fastest time in the market. Sometimes June's a little bit faster, but it definitely doesn't feel like that this year. It feels like 22 and a half days is the fastest average, active to under contract time that we're going to see. So that pace of the market is going to start slowing down going into the latter half of the year. Now, what could happen if interest rates really decide to fall, which it doesn't really seem like they're going to fall as fast as people would like. But if they do fall, this could plateau off a little bit as buyers re-enter the marketplace. But what you generally see in a year is what you've seen in 2021 or 2022 is, after May, things start to rise again, right? 2021 was a little bit of an anomaly because that was the most insane, chaotic buyer's market we've ever seen, or seller's market we've ever seen. And so people just shopped and shopped and shopped and never really climbed back up. Expect this to get back into the 30s or 40s, when our median's looking around 9 on average or so, maybe even 8. Things are moving really quick. It feels like a seller's market. Does it feel as chaotic as it did a year ago? Absolutely not. We have more than 2 times the days in MLS. We have a little bit more inventory. Things are taking a little bit longer. We have a fraction of the amount of buyers out there shopping, right? So this is a very different environment than where we were. And I think the biggest thing you want to take away from this entire presentation is what are a couple of talking points you can use with your buyers to make them feel comfortable, right? You should be looking for data in here that helps people, acclimate to this new environment that we are in this year rather than last year. And you can see it in our actives and solds. We're down across the vast majority of the market, and the lower end of the market would probably be moving a little bit faster if it had more inventory, but it's in such a shortage in inventory, below 600,000 or so, that's what's hindering that part of the market. The higher end of the market is really hindered, especially above, that 600,000 or even 800 or a million. You're really seeing it hindered by the cost of money because people are having a hard time swallowing the payment because of what they either have currently or what they were feeling like in the years past. Now you can see that really spelled out right here. Under a million, we have no inventory, right? Over 1, it's starting to rise a little bit. Over 2, we're starting to get into a balanced market. And then over 3, we're into a buyer's market already. And you're going to continue to see that ladder increase because even though the good product that comes to market, best location, best, newest designs and all of that stuff that people really like, that stuff's going off the market really fast because there's still buyers out there paying cash or, swallowing that payment to move to the area, especially in those luxury price points. But the big difference there is that the buttoned up product is what seems to be selling. Where if you get down into the lower end of the market, it's just still a frenzy, right? Because there's just not enough inventory. Look specifically between 300 and 500,000. We have less than a month of inventory. They're going off the market in 15, 16 days on average, which means the median is like 7, right? So when our median's 7 and it only takes a week to sell a property in those markets, it's just there's bidding wars in certain places and then stuff is sitting in others. And you're really going to have to dive into your localized markets a little bit more. But when you're helping your buyers understand that in their price range, it's very important to be able to articulate that to them. If you're in that $1 or $2 million price range, you're going to have that conversation with them about this market is drastically different than it was a year ago. We're seeing inventory stacking up, right? We're seeing 30% less in sales. And that's really how this is coming out in the wash. So this is going to change to a more normalized market at some point. But as interest rates start to come down, expect that a lot of that demand to come back to the higher end of the price, to our price bands, because the higher end of the markets are right now so hindered by cost of money. And I think buyers that can afford to wait have really been sitting on the sidelines, just kind of waiting. So you can really feel that. Now, that doesn't change things for the lower end, right? Sold analysis, we're down by about 25% year over year in sales. As we kind of keep watching this, most markets are around 20-25%. Albert's kind of the slowest market at minus 33% out there. When you got Broomfield, it's only down by 7%. So certain markets are moving at different paces than others, but it's still, our sales are struggling to keep up. And this is one of the slowest years we've had in the last decade, right? I mean, we haven't seen the sales like we thought we would see, but it's largely due to buyers or sellers not bringing inventory to the marketplace. And you got that super reduced amount of buyers out there because of the cost of money. And money costs have just not come down as fast as expected, right? We hit in 4% inflation this month, but world markets also are, not buying into the U.S. bond markets, and there's all these other factors. So as that changes, as it will continue to change, all we can operate on is what we know, right? So what we know right now are these facts. All right, so let's go to average sales price. I think this is one absolutely worth talking about because year over year we're showing down 2%. Now that's 2% for like the peak of the market in the biggest frenzy we'd ever seen. So really, are we off that far, right? That's the biggest question. I think the one thing we know is we chase prices down from May all the way through January. But that chase was really barely, it was still above where we were at that time the previous year. It's always very seasonal, right? So you're going to see some seasonal increase, and then you're going to see a rise throughout the year again. So look at the history, right? I think when you're articulating this to sellers, you really want to articulate the history because you're going to get appreciation over time, right? It takes time to make money in real estate. And no matter when you bought in the cycle, it just matters when you sell. So unless you have people that bought in March, April, May last year, you probably have made quite a bit of money. So they really need to pay attention to that. We really need to watch that. And if you're pricing homes, you just can't take comps from that time period, right? There's a lot of other comps out there to help support the price of a house, but we really need to kind of work through that. The other part of this is, here's the attached market. Attached market bounced around a little bit, but it really hasn't been affected quite as much, right? A lot less of that dropping price over the last year, a lot less of that price increase this year. So it's kind of still coming out in that same area, but look at those year-over-year numbers, right? They're way less and way less dramatic than what you saw in the detached market. Now, this is a good one to help articulate this. So let's look at it specifically in detached. Detached is down, year to date about 19%, year over year 26% right now. It's just a lot slower in the detached market. I think that urban sprawl we felt during the pandemic is starting to change just a little bit, and people are realizing, location, 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 like we always say in real estate. Look at Broomfield, for instance. Broomfield has done remarkably well this year. You can see that sales are only down in detached by 8%. Now you go over to the attached market, and in Denver Metro, you've seen that down about 21% as well. It's down even a little bit more than what you saw in other areas, but it really depends market to market here. Look at Douglas County, 5% more sales in the attached market this year, right? Look at some of the other places that are not trending with everywhere else. Jefferson County seems to be doing remarkably well. Broomfield and Adams are doing well comparatively, but then, you've got places like the city of Denver, and they're really struggling with their attached sales. So all these markets are worth looking at very specifically and individually. And if you need that information, don't hesitate to reach out to us. The last one I wanted to talk about is this one right here. The percentage sold price to list price. This is the attached slide, but they're very similar between detached and attached. Like I said, it's a seller's market, right? We don't have a lot of inventory. 100% listed sale price is still a very seller favorable market, right? Because they're getting at asking price all the way through closing. It's just dramatically different by 5% from this time last year. So you can see that that swing has really changed. You can see that that price point or that product type that's really buttoned up is going really well. And the other stuff is just sitting on the market, right? So when you're starting to see that, you see this huge amount of turnover in the lower end. Of course there's a frenzy. Even with the few buyers that are out there, if you get 20 showings and 3 or 4 offers, right, that's still an awesome seller's market. I think reframing that picture is really important. You get up into the ultra luxury, look at this, 3+ million price range on average, had the highest overall asking price, 107%. Now, people will definitely come and pay cash when they can. And I think Colorado is going to be one of those places where it's worth weathering the storm here. It's worth parking some money here, because we don't tend to see the recessionary behavior you see in a lot of the other markets, right? The real estate markets plateau here, and it's a good place to see that. Plus, who doesn't want to live here, right? I mean, we've really seen it year after year after year. Nobody really sees that changing. People might have to leave to retire, which we've seen in other parts of the country over the past, and you're starting to see it in Colorado. But that buyer behavior and the seller behavior is just changing and kind of getting back to pre-pandemic norms in high interest rate environments. So if you have any other questions, you have any other concerns, you want to get into some of the details with me, feel free to reach out. I'm Anthony Atlantitle. Don't forget to like and subscribe to the channel, and I'll catch you next time.